Again, today the Financial Services Committee meets to hold a hearing on the Terrorism Risk Insurance Act of 2002. This is the first full committee hearing on this subject since 2005. It's an important hearing for a number of reasons. Number one, this is a program that is due to expire in 15 months, and there are many within our economy that rely on this program and need to know what the will of Congress is. I also note that roughly half of the members of our committee have never been in Congress when this subject was debated, so I hope that there will be a multiple of views presented today on the topic in this hearing. I will admit that the timing of the hearing, I had originally thought I would have this hearing in December, but the gentleman from New York, Mr. Grimm, is very persistent. Days where he is patiently persistent and days where he has been painfully persistent. And so at his persistence, we are having this hearing today, and I certainly know of no more vocal or outspoken advocate for the continuance of this program than the gentleman from New York, Mr. Grimm. Obviously, the other gentleman on my side of the aisle from New York, Mr. King, has also been exceedingly vocal and active, as have on the Democratic side the gentlelady from New York, Ms. Maloney, and the gentleman from Massachusetts, Mr. Capauano, who have also co-authored legislation to continue the program. Their voices are important, and we will hear from them soon as part of a member panel. Although I was not personally here in 2002, I know that the original purpose of the TRIA bill, as the report that accompanied the bill that came out of committee, was to, quote, create a temporary industry risk spreading program for foreign acts of terrorism and facilitate a transition to a viable market for private terrorism risk insurance. Before I go on for what was debated as the purpose of the bill, I think it is important to say what the bill did not purport to do. I cannot find anywhere in bill text or legislative history to suggest that anyone thought that the passage of TRIA would somehow prevent future acts of terrorism. It could not take away 9/11. So to some extent, we are debating today who should bear the cost of terrorism acts. Should it be insurance companies and property owners or taxpayers? I think we all acknowledge a far more important debate is the prevention. Our committee has some part of that jurisdiction. Other committees down the hall have a far greater part of it. At the time, it was a thought that originally TRIA Act would give the insurance industry time to recapitalize and develop new models that they could price for terrorism risk and increase industry capacity. 3 years later, in 2005, Congress decided to make TRIA a little less temporary, extended it for 2 years. Then in 2007, Congress was back again to stretch the boundaries of modern linguistics by extending TRIA temporarily for 7 additional years and expanding it to cover any acts of terrorism, foreign or domestic. So we almost recognize that in just 5 years, TRIA has leapt in scope and quadrupled in length, neither of which I think could be mistaken for facilitating a transition to a viable market for private terrorism risk insurance. I think this begs a number of questions that I hope will be addressed in our second panel. What does constitute a temporary program? And I'm not sure how many of us actually have faith in an ex-ante recovery scheme of funds, so it begs the question, if premiums are not gathered, is this truly an insurance program? Is it an insurance program? Is it temporary? I certainly don't want to get in any trouble with the CFPB for misleading advertising. Has the 12 years, 11 years I suppose, allowed the insurance industry to successfully model and to provide products for terrorism coverage without taxpayer support, or has TRIA prevented it? In 2007, the Congressional Budget Office stated, quote, in the absence of a federal mandate, insurers have a strong incentive to offer terrorism coverage to their commercial customers because to do otherwise risks their losing business on other property and casualty lines. Has not the capacity in the standalone terrorism insurance program increased significantly since 9/11? We all agree the risks of terrorism are unique, but are they so unique as to be uniquely uninsurable? There have been times in our nation's past where other phenomena in American history were deemed unique. Airline crashes, oil spills, power outages, criminal riots, data losses, and yet somehow the industry found the incentive and the ability to model and assess this risk. How was this done? How long did it take? Are some positing that all acts of terrorism cannot be modeled, or is it merely those nuclear, biological, and chemical that cannot be reserved against or cannot be sufficiently modeled? And probably come to no surprise to anyone that if we posit that private insurance companies are incapable of modeling this risk, how can we be convinced that the federal government is any better, as our national flood insurance program is underwater, pun intended, PBGC, $34 billion deficit, and as we look at the national debt clock, which I know is inconvenient to some, it principally turns because insurance programs, be these social insurance programs of Social Security and Medicare or others, the government has not done a particularly good job. That, ladies and gentlemen, represents a man-made disaster, and it will certainly color my opinion on this matter. I have an open mind. It is not an empty mind. It remains a skeptical mind. I now recognize